Hello everyone and welcome to my channel. Today, I am going to discuss Top 10 Stock Market Crashes in the World. When the stock market crashes, it's as if the financial world holds its breath, and the reverberations are felt far and wide. The abrupt, often harrowing descent of stock prices can send shockwaves through economies, businesses, and individual portfolios. Such crashes are not merely events in isolation, but rather pivotal moments in the complex dance of finance, a stark reminder of the vulnerability of our interconnected global markets. They challenge our confidence, unveil the fragility of wealth, and expose the deep-seated fears and hopes that underpin our financial systems. Whether triggered by economic downturns, speculative bubbles, or unforeseen catastrophes, stock market crashes remain indelible chapters in the ongoing story of our financial world. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Number 10. Wall Street Crash of 1929. The Wall Street Crash of 1929, also known as the Great Crash, was a catastrophic stock market collapse that marked the onset of the Great Depression in the United States. On October 29, 1929, also known as Black Tuesday, the stock market experienced a historic downturn. It was fueled by speculative excess, excessive borrowing, and a lack of regulatory oversight. Stock prices plummeted, leading to massive financial losses for investors. The crash caused widespread bank failures, unemployment, and severe economic hardship, with millions of Americans affected. The event highlighted the fragility of financial markets and the need for proper regulations. It also led to significant financial reforms and the establishment of the Securities and Exchange Commission, SEC, to prevent future crises. Number 9. Black Monday, 1987. Black Monday, which occurred on October 19, 1987, is one of the most infamous stock market crashes in history. It's known for its dramatic and sudden collapse of global stock markets, including the U.S., where the Dow Jones Industrial Average dropped over 22% in a single day. The crash was primarily driven by a combination of computerized trading, portfolio insurance strategies, and a general sense of panic among investors. While the crash was a spectacular one-day event, it didn't lead to a prolonged economic downturn like the Great Depression. In fact, markets rebounded relatively quickly in the following days. Number 8. Financial Crisis of 2008. The financial crisis of 2008 was a global economic catastrophe triggered by the collapse of Lehman Brothers, one of the largest investment banks in the world. It stemmed from a housing bubble burst and widespread mortgage defaults, which resulted in a banking system crisis. This crisis led to a credit freeze, a sharp decline in stock markets, and a worldwide recession. Governments and central banks implemented massive bailouts and stimulus packages to stabilize the financial system and prevent a complete economic collapse. It also exposed issues of inadequate risk management and regulatory oversight in the financial industry, leading to subsequent reforms and tighter regulations to mitigate such risks. Number 7. Dot-com Bubble, 2000. The dot-com bubble of 2000 was a speculative frenzy in the stock market, primarily involving technology and internet-related companies. During the late 1990s, investors were drawn to the promise of the internet, leading to inflated stock prices for many dot-com firms. However, a significant number of these companies had no profits or even revenue, and the bubble burst in 2000. This event resulted in the collapse of numerous internet startups and a sharp decline in stock prices. The aftermath led to substantial financial losses for investors and a market correction. It served as a stark reminder of the risks associated with investing in companies with unproven business models and marked a shift towards more cautious investment practices. Number 6. Panic of 1907. The Panic of 1907 was a severe financial crisis that occurred in the United States. It was marked by a run on banks and trust companies, which led to widespread financial turmoil. The panic was triggered by the collapse of the Knickerbocker Trust Company, leading to a loss of confidence in the banking system. Notable financier J.P. Morgan played a pivotal role in stabilizing the situation by organizing a consortium of banks to provide liquidity, preventing a complete economic meltdown. This crisis highlighted the need for a more stable banking system, which ultimately led to the creation of the Federal Reserve in 1913, with the aim of preventing future financial panics and bank runs. Number 5. Japanese Asset Price Bubble, 1989. The Japanese asset price bubble, which peaked in the late 1980s, was a speculative frenzy in Japan's real estate and stock markets. Property and stock prices skyrocketed to unsustainable levels, driven by excessive lending and speculation. However, the bubble burst in the early 1990s, resulting in a prolonged period of economic stagnation known as the Lost Decade. The burst of this bubble led to severe financial distress, banking crises, and deflationary pressures, with long-lasting effects on Japan's economy. It served as a cautionary tale of the dangers of asset bubbles and the challenges of recovery from such economic crises. Number 4. Asian Financial Crisis, 1997. The Asian financial crisis of 1997 was a region-wide economic disaster that primarily affected East and Southeast Asian countries. It began with the devaluation of the Thai baht, triggering a massive currency and financial market collapse across the region. The crisis was fueled by excessive foreign borrowing, inadequate regulation, and speculative bubbles. It led to bank failures, sharp stock market declines, and a severe economic recession. International financial institutions, like the International Monetary Fund (IMF), provided bailout packages, but the crisis had long-lasting effects, exposing structural vulnerabilities in Asian economies and leading to reforms and increased financial stability efforts. Number 3. South Sea Bubble, 1720. The South Sea Bubble of 1720 was a significant speculative financial bubble in England. The South Sea Company's stock price soared to unsustainable heights, driven by the public's belief in the company's ability to reduce the national debt. However, the company had no real plan to achieve this, and it was largely a scheme to enrich its insiders. When the truth was revealed, the stock crashed, leading to a financial crisis. The British government passed the Bubble Act in response to the bubble's burst, which aimed to prevent fraudulent stock schemes and regulate joint stock companies, marking an early step in securities regulation. Number 2. Russian Financial Crisis, 1998. The Russian financial crisis of 1998 was a severe economic and financial crisis in Russia. It was triggered by a combination of factors, including a devaluation of the Russian ruble, a default on government debt, and declining oil prices. The crisis led to a sharp decline in the Russian stock market, widespread bank failures, and economic turmoil. The Russian government's inability to meet its debt obligations and stabilize the economy prompted a massive international bailout effort led by the International Monetary Fund (IMF). The crisis underscored the challenges of transitioning to a market economy and the risks associated with emerging markets. Number 1. Tulip Mania, 1637. Tulip Mania, which occurred in the Netherlands in 1637, was one of the earliest recorded speculative bubbles in financial history. It involved the frenzied trading of tulip bulbs, particularly rare and exotic varieties. Prices for tulip bulbs soared to astronomical levels, driven by a mix of scarcity and speculation. However, the bubble burst in 1637, and tulip prices collapsed. The event resulted in significant financial losses for many participants, but had limited long-term economic impact. Tulip mania is often cited as a cautionary tale of irrational exuberance and speculative excess in financial markets. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comments section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.